There is no political will to cut spending, and there is no mathematical path to tax the nation back to solvency. Under these constraints, the rational move for the central bank is not to fight inflation but to surrender to it. This is the mechanism that JPMorgan understands. This is the reality behind the $5,000 gold targets. It is not that gold is becoming more valuable, it is that the denominator, the US dollar, is being structurally diluted to prevent a sovereign default. We are not witnessing a business cycle, we are witnessing the end of a long-term debt cycle. This phenomenon has occurred before. It follows a specific, repeatable sequence that has destroyed the purchasing power of citizens in empires stretching back 2,000 years. To understand where the Federal Reserve goes next and why the smart money is quietly exiting the bond market, we must look at the historical precedents. The pattern repeats in every civilization that chooses the easy path of currency debasement over the hard path of fiscal discipline. We begin in the 1st century AD with the Roman Empire. At the height of the Pax Romana, the Roman economy was the most sophisticated the world had ever seen. It was built on a foundation of sound money, the silver denarius. This coin was the standard of value for trade. From the foggy coasts of Britain to the deserts of Syria, a soldier knew what his labor was worth. A merchant knew what his grain would fetch. The silver content was high, roughly 98%. Pure, and the stability of the currency allowed for long-term planning, investment, and the accumulation of capital. But the seeds of destruction were planted in the incentives of the ruling class. By the time of Emperor Nero in 64 AD, the costs of maintaining the empire had begun to outpace the revenue generated. By taxes, the empire had stopped expanding, meaning the influx of plunder, gold, silver, and slaves had slowed, but the costs remained. The legions on the Rhine and Danube required payment. The bureaucracy in Rome required funding. The grain dole for the citizens of Rome, the social welfare of the ancient world, could not be cut without risking riots. Nero faced a choice. He could cut spending, which would alienate the army and the people, or he could raise taxes, which would alienate the wealthy elites. He chose a third option. He chose the monetary shortcut. Nero ordered the mint to reduce the silver purity of the denarius from 98% to roughly 93%. He also slightly reduced the weight of the coin. By doing this, he could mint more coins with the same amount of silver. It seemed like magic. He could pay his debts, fund the games, and rebuild the city after the Great Fire without raising taxes. The population did not notice immediately. The coins looked the same, they carried the same face of the emperor, but the signal had been sent. The constraint of scarcity had been broken. Once the seal was broken, the temptation to debase the currency became irresistible for every subsequent emperor. If Nero could shave 5%, why couldn't Trajan shave 10%? By the time of Marcus Aurelius, the silver content had dropped to 75%. By the time of Septimius Severus in the early 3rd century, it was down to 50%. The denarius was abandoned for a new coin, the double denarius or Antoninianus, which was essentially a copper coin with a thin wash of silver. By the 3rd century, his pay had been increased numerically, but in real terms he was destitute. The economy began to definancialize. The state's response was not to restore sound money, but to use force. People fled the cities to work on large, self-sufficient estates in the countryside, trading their freedom for food and protection. The middle class was wiped out. The currency collapse didn't just destroy the economy. It destroyed the social contract of Rome. Just like the Roman Empire, the Spanish Empire in the 16th century fell into the same trap, though the mechanism was slightly different. Spain did not debase its currency by removing metal. It debased it by flooding the system with too much metal while failing to understand the nature of wealth. Following the discovery of the Americas, Spain gained control of the richest silver mines in history, specifically the mountain of Potosi in modern-day Bolivia. The Spanish galleons, the Flota de Indias, brought back tonnage of silver and gold that the world had never seen before. The Spanish crown believed that gold and silver were wealth. They believed that by importing these metals, they were becoming the richest nation on earth. They were wrong. Money is not wealth. Money is a claim on wealth. Wealth is the goods and services produced by an economy: the food, the textiles, the ships, the tools. Spain used its newfound silver not to invest in industry or agriculture, but to consume. They used it to fight endless wars in Flanders, Italy, and against the Ottomans. They used it to import luxury goods from France, England, and the Netherlands. The result was the price revolution. As the supply of silver skyrocketed in Spain, the purchasing power of silver collapsed. Prices in Spain rose higher and faster than anywhere else in Europe. A fanega of wheat in Andalusia cost 4 times as much in the late 16th century as it did at the beginning. The cost of living for a Spanish peasant or artisan became crushing. The tragedy was that Spanish industry was destroyed by this inflation because prices were so high in Spain. Spanish goods became uncompetitive abroad. It was cheaper for Spaniards to buy cloth from England or weapons from Germany than to produce them domestically. The silver flowed right through Spain. Landing in the pockets of merchants in London, Antwerp, and Amsterdam, Spain became a conduit, a funnel, that poured the wealth of the Americas into the coffers of its enemies. The Spanish crown, despite owning the mines of Potosi, went bankrupt not once but multiple times. King Philip II, the most powerful man in the world, declared sovereign default in 1557, 1575, 1596. And 1607. The state had access to unlimited money, but it had no fiscal discipline. They borrowed against future silver shipments to fund current wars. When the shipments were delayed by storms or pirates, or when the costs of war exceeded the value of the silver, the system snapped. The human cost was a hollowed-out society. The hidalgos and the nobility who lived on fixed rents from their land saw their real income evaporate. The peasantry was crushed by taxes levied to pay the interest on the king's debts. The productive middle class was decimated. By the 17th century, Spain was a shell of its former self, a cautionary tale of what happens when a nation confuses money with productivity. The abundance of money did not create prosperity. It destroyed it. Just like the Spanish Empire, the Weimar Republic in Germany provides the most clinically precise example of how modern fiat currency is destroyed when the link to hard assets is severed completely. In 1914, before the First World War, the German mark was a gold-backed currency. It traded at a rate of 4.2 marks to $1. It was sound. It was stable. But the war changed the incentives. The German government expected to win the war quickly and pay for it by extracting reparations from the defeated allies. They chose not to raise taxes to fund the war effort. Instead, they suspended the convertibility of the mark to gold and began to borrow and print. Germany lost the war. The Treaty of Versailles imposed massive reparations payments on the shattered nation, payable in gold or foreign currency, not in the paper marks they could print. The industrial heartland of the Ruhr was occupied by French and Belgian troops in 1923 to enforce payments. The German government, in a gesture of passive resistance, ordered the workers in the Ruhr to strike. To support these striking workers, the government did the only thing it could do: it printed money to pay their wages. This was the spark that ignited the inferno. Money was being created with zero production to back it. The supply of paper marks flooded the economy, while the supply of goods, coal, steel, food plummeted. Due to the strikes and the war damage, the numbers defy comprehension. In January 1923, US dollar bought 17,000 marks. By July, it bought 353,000. By August, 4.6 million. By September, 98 million. By November, $1 was worth 4.2 trillion marks. The daily life of a German citizen became a waking nightmare. Prices did not rise by the year or the month, but by the hour. A cup of coffee ordered at 5,000 marks might cost 8,000 marks by the time the bill arrived. Workers demanded to be paid twice a day. Upon receiving their morning wages, they would rush to the nearest shop to buy anything: bread, soap, hairpins, because by evening the money would be worth half as much. The middle class, the backbone of German society, was liquidated. These were the people who had done everything right. They had saved. They had bought government bonds. They had put money in savings accounts. They had pensions. In a matter of months, the life savings of a doctor, a professor, or a civil servant were reduced to the value of a single loaf of bread. A lifetime of labor was erased. Conversely, those with debt were liberated. Speculators who had borrowed massive sums to buy land, factories, or foreign currency paid off their debts with worthless paper. The moral hazard was absolute. The prudent were punished and the reckless were rewarded. The social fabric of Germany was torn apart, creating the vacuum of rage and desperation that would eventually be filled by extremism. The flight into hard assets was the only survival strategy. Those who owned farmland, gold, or foreign currency survived. Those who held paper died. Financially, the pattern repeats in 7 distinct stages. Stage 1 is sound money. The nation has a currency backed by a hard asset, usually gold or silver. They promise this is a temporary emergency measure. Stage 4 is inflation and asset bubbles. The newly created money flows into the system. Initially, this creates a feeling of prosperity. Stocks rise, real estate prices soar. The government can service its debt easily with cheaper currency. However, consumer prices begin to tick up. This is the critical turning point. Inflation becomes persistent. The bond market begins to rebel, demanding higher yields to hold the government's debt. At this stage, capital controls may be introduced. The government may discourage or ban the ownership of gold or foreign currencies. The currency is destroyed. Of the United States has long passed the phase of overextension. The monetary shortcut was institutionalized in 1971, when the gold window was closed, and accelerated in 2008 with quantitative easing. We have seen the asset bubbles in real estate and equities. We have seen the initial spikes of inflation which were dismissed as transitory now consider the position of JPMorgan and the Federal Reserve. The Federal Reserve is trapped. This is the gold trap. If the Fed cuts rates to save the government and the banking system, they reignite the inflation that is already simmering. Beneath the surface, this is what JP Morgan knows. When banks like JP Morgan predict gold at $5,000, or when central banks in China, Poland, and Singapore buy record amounts of bullion, they are not speculating on the metal, they are shorting the dollar. They are preparing for the moment when the bond market realizes that the real yield on treasuries is permanently negative. The trap is set for the ordinary investor who believes that cash is safe or that government bonds are risk-free. In a regime of financial repression, cash is a guaranteed loss. They argue that there is no alternative and that the cleanest dirty shirt theory will keep capital flowing into the U.S. This is a valid point. In the short term, the dollar can remain strong relative to other fiat currencies like the yen or the euro, which are facing their own crises, but it cannot remain strong relative to hard assets. And this is the nuance that many miss. This occurs if the bond market revolts and refuses to fund the government, or if the central bank loses control of the currency narrative. This leads to the Weimar or Venezuela scenario, a rapid loss of confidence and a flight to hard assets. This is the high-risk band usually triggered by an external shock or a major policy error. Finally, there is the reset and restructure. Every fiat currency regime eventually ends. This often involves the introduction of a new system. In the modern context, this could be a central bank digital currency or CBDC. A CBDC would allow for total control over the velocity and usage of money, potentially including negative interest rates or expiring currency to force spending. It is the ultimate tool of the technocrat to manage the decline. The trajectory is set by the arithmetic of the debt